September usually has a reputation for volatility and drama. This year, it surprised us all. Stocks rose, bonds caught a bid, and interest rates started to blink. Hi, my name is Scott Jacobs, and I'm a partner and wealth advisor at WRP Wealth. Today, let's take a look at what's been moving the markets lately and the factors that drive those changes. Well, the Fed nudged interest rates lower. Lots are applauding that and very excited. In mid-September, the Fed cut rates by 25 basis points, putting the rate at 4% to 4.25%. That range, and it signaled room for more if the labor market cools. So what does this mean to most individuals and families and investors? Lower rates can ease borrowing costs for sure over time, and may eventually reduce cash yields. It's a good reminder of how different interest rate environments can influence borrowing costs, savings, and investment sentiment. Stocks had their best September in over 15 years. Very unusual for a month that's usually the worst month of the year historically, give or take a month. The S&P gained about 3.5% in September, and the NASDAQ was up even better. That's rare for a month that's usually volatile and traditionally a down month, as I said. While September's strength was helped by things like AI momentum, the rate cut, each of which can reverse very quickly. Market swings are part of the investment landscape. While short-term results can draw attention, the long-term perspective is what always matters most. Bonds felt useful for the first time in a while. Core U.S. bonds were positive in September and were up solidly year to date. Meanwhile, the 10-year Treasury dipped below 4% during October headlines, which is another sign that things are loosening at the edges. That dynamic in particular shows how bonds can respond differently than stocks when rate expectations change, which is one of the reasons why many investors need to have a diversified portfolio. The September Consumer Price Index is out. The September CPI, also known as an inflation gauge, that came in at 3% this time around, slightly higher than August's 2.9%. That small uptick shows inflation progress continues, but remains uneven month to month. Combined with cooling rates and stronger market performance, it suggests the Fed may be closer to its soft landing goal, though the path remains uneven. So September gave us plenty to process and let marinate, and it's a good example of why thoughtful planning matters most through changing markets. Which of these shifts do you think matters most for your financial life and your plan? Let's talk about it in the comments.